place a lot of emphasis on our strategic asset allocation, which is a target mix of various assets, because sticking to that target mix is the best way to achieve desired long-term outcomes. When we invest over the long term, the majority of asset class returns are based on the financial productivity of those assets. And this is important because when we look at returns over long-term time horizons, the impact of business and economic cycles tends to wash out over time. And based on decades of research, taking a long-term approach to investing is a time-tested moneymaker. By targeting a mix of assets, strategic asset allocation helps to overcome concentration risks and behavioral biases. In our portfolios, we also ensure that the drivers of returns and the drivers of risk in the portfolio are spread out across various macroeconomic and fundamental factors. Through diversification, we're exposed to a broad array of return levers that can reduce risk and generate wealth. Also, by buying a mix of assets, we can participate in relatively better performing assets at any given point in time. When we construct our portfolios, we consider the investor's goals and risk tolerance, time horizon, income needs, liquidity preference, tax considerations, unique circumstances, and attitude towards global investing. That said, there are a few key long-term investment principles that are reflected in our portfolios. The first key principle is that equities have historically been the cornerstone of portfolio wealth generation, and we expect that to continue. Equity prices typically exhibit higher variability or risk than bond prices over short-term periods, and a willingness to accept this risk, called the equity risk premium, has historically been rewarded. The second investment principle is that bonds are a diversifying asset and can therefore significantly reduce the portfolio risk by measure of volatility and improve portfolio outcomes. Another investment principle is that structural risk premiums, like the credit premium, which arises from investors being rewarded for taking on default risk, or liquidity premium, which compensates investors for locking in their investment for a defined period of time, can generate structurally higher returns and further reduce portfolio risk. And lastly, we can modify our currency exposures through overlays or hedging to meaningfully improve the return or volatility profile of our portfolios. Some of these principles will be more important to certain clients than others, so our portfolios will weigh these differently across portfolios while staying true to those principles. 2022 was a difficult year for multi-asset investors, as the high inflation and rising interest rate environment was challenging for both equity and bond returns. But the current rate environment and broader market conditions support holding a diversified portfolio of stock and bonds. Bond and cash yields now offer a powerful source of return potential, and higher yields are generating better income than the past, which will at least partially shield the portfolios from equity drawdowns. Also, government bonds should benefit from a scenario where the Bank of Canada cuts rates to stimulate the economy. Patience has historically been rewarded, as has a willingness to take appropriate risks. And a key risk for investors in the current environment is driven by the disconnect we're seeing between economic data, fixed income market signals, and equity market performance. Economic data, although reasonably resilient so far, is showing signs of weakness when we pull back layers of various economic indicators. Meanwhile, the inverted bond yield curve demonstrates the market's pessimistic outlook, while equity markets have been more optimistic. And when not all signals point to the same potential outcome, it's easier to get them wrong. The momentum can be persistent, and asset prices can deviate from underlying fundamentals for a long time. This makes market timing really hard to get right. So our advice for investors today is to look through market and economic cycles, remain invested, and stick to a long-term strategic asset allocation. This is the best course of action for achieving long-term investment objectives.